Good evening, everyone, and thank you for joining us. The fixed income market has been navigating an eventful few months. Bond yields have been volatile, policy rates have already seen meaningful cuts, and yet transmission at a longer end remains muted. At the same time, global uncertainties around US rate policy and trade tariffs continue to shape investor sentiment. Against this backdrop, today's session will focus on the fixed income landscape, where yields stand today, how policy and macro trends are evolving, and most importantly, how investors should think about their positioning their portfolios. I am Sandeep Solanki, product specialist, and I'm joined by Mr. Anurag Mittal, head of fixed income, who will walk us through the current dynamics and opportunities. After this session, we'll open the floor for Q&A. So please feel free to send your questions during the sessions. With that, let me hand over to Anurag.
Thanks, Sandeep. Good day, everyone, and thanks for joining in our fixed income webinar for the month of September 2025. So this was the month after conclusion of most of the trade deals that the US had with its trading partners. It was also the month after the RBI MPC policy. So broadly, the bond market digested the policy. The bond market also tried to assess the long-term implications of the US trade measures, as well as other key developments across asset markets. So in this webinar, we'll be discussing the key events, both global and domestic, and what do they mean for rates going ahead, and what kind of portfolio strategies are best suited in the current climate. So we'll start with the global trends and the key global factors shaping up the fixed income market, and then we'll come to the domestic, key events. So broadly, when the whole tariff-related measures started from April, which the U.S. termed as Liberation Day, there was a widespread expectation that because of these tariff-related measures, global trade will slow down and global economic activity will also moderate, which should lead to at some point more monetary easing by central banks, as long as there is no major inflationary shock on a durable basis. In fact, in the last month, when we saw the PMI numbers, both manufacturing and services, we saw some slowdown. But largely, what we saw in the last month of August was quite a reversal and quite a surprise for everyone. As you can see on the left-hand side of the chart, the manufacturing PMI again turned above 50 after being in decline for the last 6 months. If you look at the services also, they appear to be quite unaffected from all the tariff-related issues. In fact, they are at one of the higher levels in the last 8 months. So what gives? So if we really see what happened in the month of August was so there is a certain threshold which is called de minimis exemptions in the US, which is at around $800. So anything less than $800 is not subject to the usual tariffs. And that's why what we were seeing in this month of August was when the US was supposed to end this temporary stopgap arrangement. Also, there was a lot of export boost from most of the Asian countries towards the US to ensure that their goods are in place ahead of that withdrawal. The second thing, one very interesting phenomena has been happening in the last 6 months. Chinese exports to the US are slowing down, but Chinese exports to other Asian countries have been picking up, and Asian countries, except China exports to the US, are also rising. So what was happening in a way was possibly some amount of transshipment was also happening, where China was exporting its probably goods destined for the US to other Asian countries, where it was getting assembled and coming to the US, which is in common parlance called as transshipment. So far, US was tolerant, and US was not focused too much on the original source of goods which was getting imported in the US. But last month, the administration also announced that it will be looking at transshipments very, very closely, and hence there was also a push from the exporters of these regions to ensure that the the original goods, or whichever are they operating from, they also get pushed towards the US in fast fashion. So those were the two main reasons that we saw a sudden pickup in manufacturing PMI as well. Like I said earlier, the service sector is still continuing to be quite strong. Overall, the job market remains quite stable, although it's moderating from its high levels in the beginning of the year, but overall it remains quite stable, and hence we are seeing overall strong activity in services. If you look at the right-hand side of the chart, which is HSBC Economic Activity Surprise Index, which basically monitors actual numbers compared to the consensus estimates. If we look at both EU and US, we saw an upward surprise in the month of August. So compared to the consensus market estimates, both on the concurrent indicators, whether in the US or EU, we saw strong pickup in economic activity. What it really means going forward? Does it mean that economic activity will remain strong in the year ahead as well? So far, we have seen front loading of exports towards the US ahead of key deadlines. But what really remains to be seen is how the price component of PMIs behave going forward, because so far there is not too much of a strong evidence of full pass through of tariffs to the final goods. But one of the key, observations that we had in the last 6 months was there was a lot of front loading in exports towards the US as well. So probably so far, there was enough inventory in the system to ensure that there is not too much of goods inflation. But as all those inventory gets depleted, it remains to be seen that what kind of tariffs will be absorbed by the exporters or importers, and how much of that tariffs will be passed on to consumers. So if we continue to see that all the price pressures are being absorbed between the exporters as well as the importers, probably then the inflationary impact on the consumer will be minimal. But our sense is that some amount of cost will be passed on to the consumer as well. So we really need to see what is the kind of impact does it have on headline inflation 3 months, 6 months down the line, and what it means for the monetary policy. So this is something which we believe that needs to be monitored, and because the PMI numbers gives us a real-time sense on how the producers and the manufacturers are seeing the price trends and at a real-time basis. If you look at commodity prices, so despite expectation of slowdown in economic activity, we saw a rally in the commodity index as well, largely basis the spectacular rise in gold and silver. So as we know, gold and silver are large components of the commodity index. So despite oil remaining stable, despite industrial metals remaining largely stable, these two metals have done really well. One of the reasons that precious metals have been doing quite well in the last 6 8 months is that one, there is a certain expectation from the Federal Reserve, from the U.S. administration, that they need to cut policy rates. In fact, there was even a legal action against one of the Fed governors, so that she resigns in due course, which is leading to some market participants questioning the independence of Federal Reserve going ahead. So, in case where market continues to believe that the Federal Reserve will cut rates come what may on inflation, and it will let real rates go down, then there is a natural tendency amongst market participants to buy real assets, and gold or silver are some of the major uh, inflation hedges in this case. Secondly, as because of geopolitical uncertainty and economic uncertainty, and a lot of actions by the US administration on trade related and economic related measures, there is also a new tendency amongst emerging market central banks to diversify their FX reserves from the US dollar towards gold as well. So that's also leading to gold prices going up in recent months. And as gold prices go up, it is leading to some pullback in silver prices as well. So that's one of the key reasons that we are seeing gold and silver prices probably, the diversification trade that the central banks are carrying out, especially in the BRICS economies, may continue for some time. As far as global food prices are concerned, while on the month-to-month basis, they were not significantly up, but if you look at from a YOY perspective, they were up 7.5% on higher vegetable oil and meat prices. There was a very strong demand for meat coming from US and China, and the supply has been quite tight as the Brazil market, which is one of the key exporters of beef and pork, was seeing some supply chain pressures. And as probably as Brazil normalizes, we should be able to see some slowdown or moderation in food prices. On vegetable oil prices, the demand, especially for palm oil, has been very, very strong, and that is also leading to some again trickle down, price action in other oils like sunflower oil, etc. Probably in next 2 3 months we should see some moderation in demand in the vegetable prices as well, and we should moderate. The biggest comfort that we are seeing right now, the cereal prices continue to be quite modest. The harvest globally has been quite robust, and hence we expect cereal prices, which form a very large component of domestic food inflation in India, they continue to be quite manageable. So we talked about, the expectation of moderation of economic activity. We talked about in the previous slide how due to economic uncertainty, central banks across the world are diversifying their U.S. holdings into gold, and which is also leading to some price action on silver as well. What's also happening, especially in the last couple of months, is because of expected slowdown in growth as more tariff related measures take place. The bond market is anticipating some fiscal pressures also in most of the major advanced economies. So as we would recall, a couple of months back, Germany already announced that they will increase and expand their fiscal deficit to take into account more defense related spending, and also to support their businesses and households affected by the tariff related issues. We are also seeing some pressures in the UK, France, and other advanced economies to ensure that they are able to maintain their welfare measures in the light of declining growth in GDP. The same action we are seeing in Japan as well, where inflation has been quite challenging. On the other hand, because of adverse trade related deals with the US, the PM had to resign. So there is also a concern in the Japanese bond market that the incoming PM, to offset the impact of trade issues with the US, will have to become more populist, and hence they do not really see any major consolidation on the fiscal side in Japan as well. So what is happening is quite interesting. So in the near term, the bond market believes that the central banks, because of probably pressure from the administration or because of near-term decline in inflation, could cut interest rates, and hence we are seeing the 2-year bond yields and 10-year bond yields, especially in the US, going down. But interestingly, if you look at the 30-year bond yields, and this is data going back all the way till 2005, so it's a 20-year data, the 30-year bond yields are back to the 20-year highs. So if you see for most of the major economies, they are at very high levels because it reflects markets growing discomfort with the fiscal pressure as well, and secondly, probably a certain helplessness of the governments to rein spending. So overall, bond market believes that one, interest rates could come down despite tariff-related inflationary shocks, and secondly, governments will have no choice in the advanced economies who are doing deals with the US to spend more to offset those imbalances, and that's why we're seeing pickup in these bonds. And but a natural question comes: why suddenly? So if you look at the chart on the left-hand side, which reflects the net debt to GDP of these major economies, and the 2025 is IMF estimate. If you look at for most of the economies, it's the net debt to GDP position is rising. So one of the key assumptions that we had post COVID was that the COVID related spending that most of these advanced nations did between 2020 and 21 at some point will be contained, fiscal will be consolidated, and in due course of time, the debt to GDP positions of these economies will become better. But what we are seeing increasingly is that it's becoming very difficult for these nations to rein in their welfare spending. So the fiscal continues to expand, and the growth continues to decline. So overall, their debt to GDP position is becoming slightly challenging for most of these economies. It's in very contrast to the emerging markets, especially like India, where we have seen fiscal consolidation after COVID. So on one hand, emerging market economies have been reflecting strong fiscal consolidation, which has allowed their central banks to cut interest rates in the last 8 months. And whereas on the other hand, if you look at advanced economies, as they could not really consolidate the fiscal in the same manner or the same magnitude as the emerging economies did, their central banks' hands are tied, their governments' hands are tied, because as they see now, their activity reflecting some slowdown, they are not able to intervene meaningfully, to really boost expenditure and to support their businesses. Coming to the movement on the 10-year sovereign benchmark yields. The previous slide we talked about the 30-year benchmark, and this particular slide we are talking about the 10-year bond yields. So as we can see, for most of the advanced economies, we saw a rise in bond yields. The only exception was the US, which saw 15 basis decline in the bond yield, as now the market is expecting some moderation in economic activity in the US, especially in the labor market, where we saw some negative revisions in the previous months as well. So now the expectation from the Federal Reserve is that Fed will be able to cut interest rates when they meet up for the September FOMC meeting. It was also indicated by the Fed chair, Mr. Powell, in their Jackson Hole symposium, where they said that probably now the balance of risk is also now shifting towards the labor market, which the market participants see as a sign that probably apart from inflation, the Federal Reserve is also looking at growth and probably will be in a position to cut. So, given the slightly light positioning in the US, we saw some rally. But if you look at for the most of the other economies, whether it's UK, Germany, Japan, Australia, or South Korea, we saw a rise in bond yields. We talked about how the expectations from the Federal Reserve are changing. So we are seeing the same thing in the financial conditions and index as well, which became easier incrementally in the month of August, as now more market participants expect Federal Reserve to cut rates. In fact, as we speak right now, the expectations from the Federal Reserve is that Federal Reserve will look to cut interest rates by the end of December 26 by cumulative 150 basis points. At the time of this, by month end, it was still 100 basis points. So still, the bond market expects Federal Reserve to cut somewhere between 100 to 150 basis points, as the focus on growth becomes more primary than focus on inflation. So for the last 8 to 12 months, the bond market has debated, and even the Federal Reserve, whether growth or inflation, which was more important. There was an increasing debate within the Federal Reserve, but overall, the majority or the consensus with the Fed as well as with the market was that the labor market continues to be quite stable. Economic activity is quite strong despite the uncertainty of tariff, and hence the Federal Reserve needs to keep its focus, all the way on inflation. But now, as labor market continues to deteriorate in the US, now job openings are declining. Probably the balance of importance is now shifting towards growth rather than just inflation. And as inflation further may slow down, because as the labor market continues to deteriorate, probably it will be more easy for the Fed to cut rates in this course of action. Now coming to domestic trends. So overall, we saw the release of Q1 FY26 GDP. So we on the left-hand side of the slide, you have the output-based GDP. On the right-hand side, you have the expenditure-based GDP. So on the expenditure-based GDP, we saw growth coming at 7.8%, which was about 1% higher than consensus estimate of 6.8%. As we can see, we saw strong growth in most of the components, whether it was private consumption, it was government consumption, probably because of the base effect of last year election-related slowdown in spending. Even the investment, which is depicted by gross fixed capital formation, was quite strong, and exports also saw a pickup because probably because of front loading of exports before the tariffs hit India as well. So, just to explain in detail, so what we saw last year, especially from the government consumption, was because of code of conduct related issues ahead of elections. Government had reduced its spending between the quarter of April to June last year, and which saw resulted in a negative growth in government spending in Q1 FY25. So because of that, if you see, the base effect was quite strong this year, and hence we saw 7.4% growth in government spending. Even if you look at the private consumption, that was expected to slow down after a moderate Q4 number of 6% in FY25. But what we are seeing is very strong pickup in rural spending as well, because probably because of welfare-related measures by the government, as well as by expectation of a strong monsoon, which is leading to reasonable spending from the rural side as well. If you look at the output-based GDP measures, what we are seeing is slowdown in mining and quarrying. This was expected because of an unseasonal and heavy rainfall between April to June. So typically whenever we see strong monsoon during this time, we see some slowdown in mining and quarrying activity, which led to a negative growth on mining from a very high base of 6.6% in Q1 FY25. So nothing to worry about. Probably this will even out during the next 3 quarters. If you look at manufacturing, that was quite encouraging. Despite a strong base, 7.6% in Q1 FY25, manufacturing remained quite strong at 7.7%. If we look at overall services, they continue to be quite high at 9.3%. It's explained even by government spending, as well as by high financial sector activity. So one of the worrying things that probably some market participants are alluding to, which is a very low nominal GDP growth. So as the government has budgeted for a 10% plus nominal GDP for FY26, and we only saw 8.8%. So some of the economists are attributing it to the deflator, which came at a 7-year low at just 0.9%, which basically led to a weaker nominal GDP. We really need to see going forward, how it evolves. But if this, overall these trends are quite, I would say, stable, and we do expect, growth despite the tariff-related issues to remain between 5.7 to 6% for FY26. One of the reasons why we also think growth could remain strong is the GST-related cuts, which we will explain in slightly greater detail in the next slide, and how that will also lead to a fiscal stimulus and probably stronger consumption in the upcoming quarters. Of course, this quarter, the Q2 will be mixed. One, because of expectation of GST cuts after the speech, on 15th of August. There was a period for 15-20 days when consumption became slightly weaker because consumers were expecting GST cuts, and hence there was slowdown in consumer spending. At the same time, there was a strong pickup in exports especially during July, because to meet the 25% tariff plus 25% penalty on 22nd of August. So there was a lot of push from Indian exporters to export those goods meant for the US to ensure that those goods are able to meet the tariff guidelines. So overall, this quarter GDP will be again mixed. So probably we need to see next couple of quarters to really fully account for the impact of GST cuts, as well as the tariff-related, impact on Indian growth. So we're talking about GST rationalization. So the government to boost growth and consumption as an offsetting measure after the tariffs has really gone not just for GST rate rationalization, but even for simplification of GST structure. So mind you, out of the 115 countries which have GST/VAT regime, only 5 countries have rates of more than 4 slabs. So which makes things quite complicated, especially for small businesses. So India, to simplify and to improve ease of doing business, again rationalize, and it removed the 2 slabs of 12 and 28. So now broadly there are only 3 slabs for us on the GST side: the 5%, the 18%, and there is a sin or luxury goods which has a 40% slab. But if you look at the structure, of the old GST versus the new GST, as we can see, about 70% of items were in the 12% tax slab, which now have moved to the 5%. The 18%, which were had only 16%, now have moved to 13%. So broadly, there is a significant reduction in the items which were at the higher end. And as far as the compensation cess is concerned, so there was not a very strong clarity as far as the current reports, but it is widely believed that the compensation cess will end when all the COVID-related borrowings related to compensation to states are repaid. So probably from next year, we will not really see compensation cess also. So if you look at the total fiscal benefit to the consumers, so if you look at just from the CGST and the SGST, which is a center and the state GST, the total benefit to consumer is about 48,000 crores. So what the government has done is they took the FY24 consumption trends into account and they extrapolated the same. So broadly, the 93,000 crores, it's a direct pass through to the consumer because of GST rationalization, and because of some item moving from 28% to 40%, they are likely to earn about 45,000 crores extra based on the FY24 consumption pattern. So broadly, it leads to a net revenue loss or a net fiscal stimulus to the consumers of about 48,000 crores based on FY24 estimates. Even if you take a 10% growth on FY24 consumption pattern, it translates to about 55,000 crores, or 0.2% of GDP, which is a direct benefit of GST rationalization. But we would argue that the biggest benefit of GST rationalization or the biggest stimulus would also come from, the phasing out of GST compensation sets. So as we know, the government was collecting about 1.5 lakh crores per year of GST compensation cess to compensate the states for a certain growth that they were promised during the GST rollout. So if we add the 1.5 lakh crore GST compensation cess and the 50,000 crores direct benefit, the total benefit to Indian consumers is about 2 lakh crores or 0.6% of GDP, which is quite stimulative, which should lead to a strong consumer demand, or should lead to over the period of next 3 to 4 quarters, because typically it takes 2 to 3 quarters for the whole impact to pass through in the inventory and the demand elasticity to work. Typically, we have seen a revenue multiplier of 1 to 1.1 historically. So for every 1 rupee of tax cut, we should see pick up in the consumption of at least 1 rupee or higher in the next 2 to 4 quarters. On the inflation side, the total GST basket or the GST cuts which are included in the inflation basket is about 16% of the CPI. So if the cuts are fully passed on to consumers, that should result in about 100 basis cut in inflation. Assuming even a 50% pass through, that should at least lead to inflation getting down by at least 50 basis points. So the RBI has assumed 3% inflation for FY26. So assuming even a 50 basis cut in inflation because of GST, RBI should be able to revise their inflation forecast by at least 50 basis points for FY26. However, we do not expect material monetary easing from RBI, because typically, as we are seeing in the US, when tariff-related price adjustments happen, it is considered a one-time shock by the central bank, and no monetary action is taken accordingly. Similarly, if in times of tax cuts also, it's considered as a one-time adjustment rather than a permanent, price decline by the central bank. So on both sides, still central banks see durable price movement, central banks typically look through these price adjustments. So while inflation forecast by the RBI may be revised downwards, till they see a material price shock durably, or they see a growth shock again from a more medium-term perspective, they are unlikely to cut rates just because of GST-related measures. They're also likely to see how the demand pans out in the festival season because of the GST-related cuts. So we believe that RBI will wait and watch for all the that how the whole fiscal stimulus is leading to higher consumption, and what kind of long-term inflationary impact or disinflationary impact in this case these GST cuts will have, and probably then only RBI may be in a position to take any monetary action if anything is needed in the first place. Coming to inflation, broadly, as we can see on the RBI estimate, like we said, given the GST cuts, RBI should be able to revise the inflation forecast downwards. But the base effects of today. So as inflation, as we can see, the last month inflation was 1.55%. So the low base effects of this year will work against the inflation trends next year. So probably we are likely to see higher inflation in H2 of FY27. So probably that's something which RBI will keep in mind. But if you look at the current inflation trends, they are quite encouraging. So if you look at the CPI diffusion index on the right hand side, the total weight of constituents which are reflecting an inflation of more than 5% is at its series low of about 13%. So the overall what we are seeing is not just inflation is falling because of lower food prices. Even on the core side, inflation is weakening, and which is broadly, supporting our case that RBI can afford to keep rates lower for longer as inflation remains stable. Even the underlying inflation remains to be quite moderate, which supports for a lower for longer rate trajectory. The other very important aspect for inflation is the monsoon, and as we know, India receives about 70% of its monsoon in the months between July to September. And if you look at the current monsoon trends, they are very, very encouraging. Overall, cumulative rainfall for India is at 107% of its long period average. Northwest India has seen about 30% higher rainfall than the average. South India has seen 10%, and Central India also at 9% overall long period average. Only the eastern part of India is in deficit. But if you look at the subdivisions wise, only 3 subdivisions and which reflect about 8% area of the country have seen a deficient rainfall. But if you look at from an area of the total sowing area, about 92% of the area of country's sowing area has got normal or excess rainfall. So it bodes quite well for food inflation going ahead as well. Even if you look at the sowing numbers, whether we look at rice, pulses, sugarcane, the overall sowing numbers look to be quite strong, as you can see. Coming to the credit side, credit growth, as we know, has been muted quite for the last 3 months. And even for this month of August, the credit growth remained moderate, especially if you look at the retail growth. Retail growth continued to soften. It was just 12% versus 12.1% in June 25. Even the personal loans and credit growth was below 10%. So it's a factor of both demand and supply. So one side, banks and NBFCs are getting cautious on unsecured loans as they see slowdown in the economy, as they see job-related losses in some of the segments. On the other hand, we are also seeing slowdown in income, some moderation in job growth as well, which is also leading to weaker demand for credit. So it's a both supply and demand issue. Probably as things normalize and as the full effect of consumption stimulus given by the government, and as well as lower rates fructifies, probably in coming quarters we should see some pickup in credit growth. But at least for the next 3-4 months, adjusting for the festival related demand, we do not really expect too much of a strong pickup in credit growth. So on the balance of payment, this was a great quarter for our current account. As we can see, the Q1 CAD came at just 0.2% of GDP, which is the lowest Q1 deficit since 2017, which is broadly reflecting strong GCC service exports, which has been the case for the last 8 to 10 quarters, as well as strong exports ahead of the tariff-related measures that the US was supposed to take against India. So we also saw uh, some pickup in uh, exports, as well as very strong services number as well. So broadly, if you look at this quarter, even on the capital account side, we saw capital flows coming back with foreign investment of 7 billion after two consecutive quarters of negative foreign investment. So overall, if we consider it was a favorable uh, month. So on the FX reserve side, probably it will not look um, on the first place that we had such a strong quarter, but we also had RBI forwards of about $24 billion which were maturing. So because of this weaker, forward position, despite the flows, RBI was able to take the delivery of those $24 billion, and hence we are not seeing a very large pickup in FX reserves. But in case RBI had not taken the delivery, it actually we would have actually seen much stronger rise in our FX reserve. So overall, this was a very positive quarter, which was which not only through exports and strong GCC, but also on the FX reserve side, RBI was able to manage the forward book as well. So just like we talked about, the rise in long-term yields globally, this month also saw a rise in long-term yields domestically as well, where the curve steepened, where 30-year yields, even on the Indian benchmark side, went up. And one of the reasons, this quarter that we are seeing is very strong supply from state governments as well. So if this chart presents the quarterly issuance and actual calendar by the states. So if you look at the last year trend, especially, in the Q1, the states borrowed only 57% of their announcement. So compared to 2.5 lakh crores which states announced in the quarterly calendar, they actually borrowed only 1.5 lakh crores because their cash position was quite strong. And hence, when if you look at the next quarter in the Q2 till date, they were able to borrow 94% of their scheduled borrowing without disrupting the market because the first quarter was quite light. But if you look at this fiscal year, they ended up borrowing 73% of their announced borrowing. So they borrowed about 2 trillion compared to their scheduled borrowing of 2.7 trillion. But if you look at the Q2 till date, they have borrowed about 94% of their actual announcements. And a large part of that borrowing is happening on the long end, which is on the 20-year plus segment, which is also reducing the demand for long-only investors in the central government long-end bonds. And hence we are seeing steepening of the sovereign curve on the central government side. We are also seeing some changing asset allocation from some pension players towards more towards equity than fixed income. And hence we are also seeing reduced demand from some other long-only players as well. And hence we are seeing a steepening of the yield curve. So more than the monetary policy, it will be the fiscal policy, especially of states, which will drive long-term yield, movement in upcoming quarters. Because of we have only discussed GST-related cuts on the center side, but if you look at the state side also, where states are doing welfare, they are facing lower nominal growth, and on the other hand, they're also seeing some GST-related reduced inflows. Because mind you, the center is impacted only by 30% on the total GST flows. States are impacted by 70%. So it's the states which will have to take most of the bearing on the GST related reduced flows, and hence we do expect states to continue to borrow in the next Q3 and Q4 as well, and that will be a bigger determinant of long-term yields than RBI monetary policy. Like we discussed in the previous slide, the yield curve continued to steepen. So as we can see, compared to the month of July, while the short end yields were quite well managed, the long end yields rose quite meaningfully. As we can see, on the 30-year yields went up by 30 basis points. On the in the 40-year also yields went up by 36 basis points. So overall, the curve continued to steepen on higher SDL supply. So broadly, this we had, if you look at the AAA yield supply, AAA yields as well, we saw some rise uh, in some parts across the 1 year, 3 year, 5 year, and 10 year levels as well. Although the movement was much more pronounced in the 30 year. One of the reasons for unfavorable movement, even on the short end, was given the fiscal, with the fiscal concerns that now the market has on government, with the lower growth, with more stimulus measures coming up. Now the bond market is concerned that probably government will try to revive growth uh, from the fiscal side, as most of the monetary actions are behind us. So from RBI side, they've already cut rates, they've infused liquidity, they have liberalized the risk weight towards unsecured loan lending. So probably the next leg of measures towards revival of growth will come from fiscal, and that is what really led to hardening of bond yields, whether it was GSEC or AAA or even the lower rated AA papers across the curve through the last month. So broadly on the outlook, like we have discussed throughout the presentation, now the next trigger for rate action will be the fiscal policy, not the monetary policy. Monetary policy has largely done its part in the last 6 to 8 months. Uh, the bond market will await clarity on how well the government is able to adhere to its fiscal deficit target for FY26, despite weaker tax collection and despite further GST cuts. So it's the pickup in growth, it's the external front, it's the stability with its trading partners, whether our export again cycle revives after normalization of relations with the US or other trading partners, which will be the most observed variables for the bond market. From a comfort factor, domestic inflation is well controlled. Uh, if you look at from a medium term perspective, global growth momentum continues to weaken. As we discussed, we are expecting Federal Reserve to cut rates as the labor market is also moderating, and hence, what we really expect from RBI is that RBI should be able to maintain rates lower for longer for an extended period. And in such kind of situation where we the bond market does not expect too many rate cuts from the central bank, but expects them to keep rates lower for longer, liquidity easy for longer, typically curve continues to steepen and moderate duration, which is typically the 2 to 5 year segment, does well. So we do expect the 2 to 5 year segment to continue to do well and benefit from the curve steepness. And hence, investors who have some appetite for to market volatility can consider moderate duration products like short term and corporate bond funds. Investors who have a horizon of more than 24 months can consider income plus arbitrage fund, as that is much more tax efficient. Investors who have a 6 to 12 month investment horizon can consider money market or low duration strategies, as they offer significantly better approval than overnight or liquid funds. So I'll stop here. I hope the session was useful, and we'll open the floor for question and answers.
Indeed, Anurag, the session, I'm sure everyone has found useful. And thank you for running us through your perspectives. Let's quickly jump to the question and answers Q&A session from the listeners. So the first question is, given that the household savings have fallen to multi-year low while leverage has risen to record levels, how sustainable is the current consumption-driven GDP growth from the investor's perspective?
So whenever there is a increase in household leverage, the only way to reduce household leverage is one, increase in savings, which again reduces consumption. The other is, you know, increase in income, which of course allows for the same level of consumption, but without affecting leverage. The third, which now the government is trying to do, is a redistribution where they are doing some tax cuts where, we saw the income tax cut in the budget where income up to a certain level has been exempt. And on the indirect taxes also now GST cuts have happened. So in a way, it's a transfer from the exchequer to the households. And hence, the one way the government is trying to address household leverage is through increasing its own balance sheet and kind of moderating the balance sheet for the households this year. Uh, the the assessment is that probably once households see more income in the hands of consumers, probably they will be able to spend more, which will start the virtuous cycle of more capex from the corporates, and it will create more jobs, more income, and hence the household balance sheets will repair at some point of time. Uh, Typically, these things, just like they take time to weaken over a long period of time, these things also take time to strengthen over a long period of time. So we really need to see how India-US relations stabilize moving forward for our export cycle to stabilize. We really need to see the benefit and the pass through of these rate cuts to the actual goods. So, as we have seen historically, uh, during a time of GST cuts or GST changes, the tax hikes are immediately passed on to consumers, but tax cuts are sometimes partially passed on and sometimes absorbed by the businesses. So we really need to see what kind of pass through happens to the consumers. And ultimately, given that a large part of our economy is services oriented, so one, if you look at, there are two sides to GDP equation, like we saw in the previous slide. One is the expenditure side and one is the output side. So if you look at the output side also, manufacturing is only about 16% of GDP. The rest is agriculture and services. So since we are a service-oriented economy, which tend to be slightly stickier, less volatile, and less cyclical, we should expect a certain rate of growth irrespective of the household balance sheets. Unless and until they weaken materially, that's a different thing. But even at the current levels, we should expect growth to be in the vicinity of about 6% going forward as well.
Thank you. Uh, Now, I have the another question, which is extension to the first one, which is tax reliefs and lower interest rates may offer temporary support to consumption. Where do you see the balance between cyclical tailwinds and structural headwinds for the Indian households over next 3 to 5 years?
So there is no structural headwind, to be honest. Structurally we are in a good place. It's largely a cyclical issue, I would say, because after COVID, we saw a strong rise in consumption. We saw strong rise in job growth. We saw very robust increase in income as well. So as we saw that cyclical upswing, now we are seeing some cyclical slowdown in all these factors, whether it's wage growth, whether it's job growth, or whether it's household balance sheet, like you alluded to in your previous question. So just a cyclical, kind of, I would say, reorientation which is happening, which is leading to some slowdown at some point of time. Like we discussed in the previous question before, either the households save, consume less in the current times, and to increase their consumption later, or after a certain time there is again pick up in job growth or income growth, which leads to higher consumption, and that higher job growth or income growth could come whether from external demand or domestic demand. So, but overall, from a structural perspective, India is in a strong wicket. It is showing us a certain growth. Of course, if one there's a difference between a steady state growth and an aspirational growth. So, like if the aspiration is to grow to 8%, probably that may not be realized because of those cyclical issues. But from a structural perspective, we can comfortably grow at 6 to 6.5% for the next 3 to 5 years. Uh, you know, Even with this cyclical headwinds in mind.
Thank you, Anurag. Secondly, the question is US bond yields have dropped as markets priced in earlier cuts, but fiscal deficits mean supply pressures remain heavy. Do you expect further downside in US treasuries, or could fiscal supply risk cap the rally from here?
So while fiscal is an issue, and that's why we are seeing a steep yield curve in the U.S. So the fiscal issues are manifested in a steeper yield curve in the US right now. So if you look at the US 2 year, which is right now trading about 3.5, the 10 year trading around 410, but the 30 year is still trading at 480. So if you look at the steepness, the market is pricing in a long term supply, but from a short term perspective, it is the market will benefit from lower interest rates in the near term. So I think the curve is quite well balanced. It is accounting for more aggressive monetary easing from the Federal Reserve. On the other hand, whether it's US or any other developed market, like we discussed previously, uh, the expectations of a fiscal overhang are more represented by the long-term yields rather than short-term yields. And that's a global phenomena. That's a domestic phenomenon. Ultimately, the duration supply of the fiscal issues are usually manifested in the long-term yields, which we already see. So I don't see any inconsistency there.
Okay, thank you. The next question is, in the current easing cycle, short duration strategies have outperformed long duration ones despite three rate cuts. How do you interpret this divergence versus the past cycles?
So there is no divergence at all. This is what we have been talking about for the last 1 year. That uh, you know, as you move towards rate cuts, typically curve tends to flatten as participants try to load up more on duration in the anticipation of rate cuts. But once the rate cut cycle starts, participants, the bond market tries to anchor, to the actual in hand rates, and that is when short end tends to perform, and the long end tends to stabilize. And the same thing has happened in India as well. That the short end has rallied and the long end has stabilized around 646 half levels. That's exactly in line with our expectations. And we do expect the curve to remain steep, uh, at least for the next 3 to 6 months as well.
Thank you. The next question is, despite 100 basis points of policy rate cuts since February, the 10-year GSEC has seen only 10 basis point transmission, with spread versus repo still close to 100 to 110 basis points. Do you see this spread compression playing out meaningfully, or will the supply demand dynamics keep the long end sticky?
So also, I think one has to see the overall performance of 10 year before the rate cuts also. So if you look at the 10 year performance, uh, so like you rightly said, the first rate cut happened in February of this year. Before that, the 10 year had rallied from 710 to 680, despite global bond yields going up. So already Indian bond market had outperformed the global bond market on the expectations of rate cuts. So as the rate cuts happened, the 10 year has gone from 680 now trading to 646, currently, and hence we are not really worried about it. Like I said, market always works on forward expectations. The market outperformed global bond market last year because of expectations of rate cuts. As those rate cuts have happened, bond market has now stabilized. From a steady state perspective going forward, the spread between the long duration or the 10-year GSEC compared to the policy rate will depend on the demand supply dynamics, apart from expectations of forward inflation and expectations of future monetary policy. As far as how things stand today, the bond market overall in consensus believes that at least for the next 12 months we are not looking at any rate hikes. So in a period of 5 half policy rate with a certain demand supply dynamics, the 10-year is quite stable between 640 to 660 for now. If the demand supply equation were to change, even from the state government side, even if it remains stable from the central government, the spreads can widen from here. But if, let's say, going forward from the external side, things were to stabilize, tax revenues were to gain pickup, probably the spreads could reduce. But our base case is that spreads could remain uh, between 90 to 120 basis range in a near to medium term basis.
Correct. Thank you, Anurag. In the interest of time, we will take one last question. I think while you have already answered this, but then for the benefit of our viewers, I would want to ask it again. Now, with nominal GDP growth easing to 8.8% and full year GDP projected to 6.5%, the growth inflation mix appears supportive for bonds. Now, in this backdrop, how investors should think about positioning their portfolios?
So the forecast of 6.5% is real GDP. What you alluded to is the nominal GDP of 8.8%.
Yes.
As far as the real GDP is concerned, like I said, previously, probably because of the tariff-related factors, growth could be weaker, about 0.5% for this fiscal year. So growth could be somewhere close to 6%. Any upward adjustment in those growth forecasts we'll have to really see the benefit of GST stimulus measures, what the kind of pass through that we see, what's the kind of demand that we see. Festival season, monsoon has been quite stable, so probably we should see demand coming quite strong from the rural side of the economy. Services, especially GCC exports, remain quite stable. So on a balance, growth, real GDP growth should be quite, you know, somewhere between 5.8 to 6% for this fiscal year. As far as the nominal GDP is concerned, if inflation remains low, like we've seen industrial metals remaining low, we've seen Brent remaining on the moderate side. Of course, it will lead to lower WPI and hence lower deflator and hence lower nominal GDP. So this is more of a statistical measure. I think what's more relevant for India, for macro investors or for RBI is real GDP. If we look at whether it's a government or it's the RBI or any macro investor, they always look at real GDP, not just at nominal GDP. Nominal GDP is more of a function or a metric used to assess tax collections. So hence it is more material from a budgetary or fiscal side. But from a RBI monetary policy trade-offs, real GDP of 6% in this kind of uncertain global environment is not bad. Inflation, like I said, is right now lower because of food-related and GST-related measures. So RBI really needs to be forward-looking, and RBI will be forward-looking, and they will probably see their inflation assessment for FY27 as well, which may drive their monetary outlook. So in this kind of situation where there are too many moving parts, we don't know how will be the GST cut pass through. We don't know how the tariff-related issues with US will resolve. We don't know how tax collections will resolve. We really have to see what is the kind of rate cuts can we expect from RBI. What is the kind of fiscal issues we can really foresee from the government. And if we take all those measures into account, broadly what we know is that we are not seeing any sharp pickup in growth. So it's not that growth will suddenly go from 6 to 6.5 to 8% growth in next 1 year at least. So in a period where we are seeing moderate growth, we are seeing moderate inflation, we can at least take one reasonable assumption that RBI will keep rates lower for longer. And in that kind of scenario, again, the simple thing is stick to moderate duration. Don't take aggressive duration calls because there are too many issues which still are evolving, and there is not a sufficient risk reward that one is getting in this kind of situation.
Thank you, Anurag, for answering all the questions. I'm sure our viewers have got a very interesting insights from you. So thank you again, everyone, for joining us today. And we trust that the insights shared by Anurag have helped provide a clearer understanding of the current fixed income landscape and the opportunities ahead. We truly appreciate your time and participation today, and we look forward to welcoming you to our next event. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.